Home mortgage interest rates are generally much higher than long-term Treasury bond interest rates. Mortgage industry professionals expect spreads to normalize, which means mortgage rates will remain low as long as Treasury interest rates remain constant. It probably will, but not in 2023. The spread is wide by historical standards. Before the pandemic, the average spread across all available data was 1.69 percentage points. In February 2019, for example, the 10-year Treasury bond yield was 2.68%. The average 30-year fixed-rate mortgage costs the homeowner 4.37%, a difference from the exact long-term average of 1.69%. Most of the time the spread is between 1.5% and 2.0%. The home buyer contacts a mortgage originator, usually a mortgage broker or bank, who quotes an interest rate. The originator then sells the loan, usually to a government-sponsored entity such as Fannie Mae or Freddie Mac. As with any intermediary, the mortgage originator is paid for this service. The promoter is paid cash equivalent to the value of the increase in the interest rate. In the first week of 2020, for example, the average mortgage interest rate was 3.72%. The average interest rate paid to investors by Fannie Mae was 2.61%. What is the difference between these two rates? A 1.11% spread. It paid the mortgage originator for its services. That payment can be considered the retail mortgage spread. When Fannie or Freddie sells a bundle of mortgages to investors, interest rates must be based on supply and demand. Investors generally think of mortgages as inferior products to Treasury bonds. Although both are considered securities, U.S. Treasury bonds will continue to pay interest for the duration of the bond. But homeowners have refinancing options when mortgage rates drop. The refinance option means that when interest rates fall, homeowners refinance. Investors no longer hold old mortgages with higher interest rates. Instead, investors now have cash that they must reinvest at a new, lower interest rate. Investors don't like this. When interest rates go up, investors go up too. They're stuck with old, low-interest mortgages that no one will pay off quickly. They want to get their cash back and buy some new, higher-interest mortgages, but that's not happening.